it's all arbitrary. What it means is your 4-hour bar may be completely different than the 4-hour bar of the guy down the street, and his 4-hour bar may be different from even the next guy down the street. So there's no uniform time frame when you go lower than a week for the Forex market. That's just the way it works because it trades around the clock. Now, there are some common ways that Forex traders look at the market. One of them is to use the New York close, where at 5 p.m. they mark that. That's actually not the New York close, the New York rollover. They mark that as the close for the day, and then the next bar starts. But then there are some traders who use midnight Greenwich Mean Time. I know some traders who use 5 p.m. London time. I know some traders who use midnight London time. So I'm sure the Asian traders will be gravitating more towards an Asian time frame. So you have to keep all of this in mind when you're looking at time frames less than a week, and this is why I put so much emphasis on the weekly time frame, because it just makes logical sense. Every trader has to stop trading on Friday, and every trader has the ability to come back into the market on Sunday. It's completely uniform throughout every single Forex trader on the face of the planet. The other uniformity is our calendar, so a monthly chart. We can all agree when a month starts and when a month ends. We can all agree when a year starts and a year ends. So that's why I gravitate to the longer time frames to develop my strategy. So my estimate is going to be based on the weekly bar. Okay? Now, my basic theory is this. When the market is trending, you'll see either the high or the low consistently broken by the close of the week. Okay? So when the market was moving up back here, okay, you can't see it so much on the screen now, but when the market was moving up, you saw consistently that the market was not closing under the low of the prior week. Now you notice I didn't say that it was closing over the high. It doesn't always have to close over the high for the uptrend to continue, and just because it doesn't close above the high, that also doesn't mean that the uptrend has ended. It's only when the weeks start closing below the low that I consider an uptrend to be over, or if the market's moving down, what I'll look for is the market to close above this high in order for this new short-term downtrend to be created. Okay, that's my criteria, at least to give me the signal that the uptrend or the trend itself is changing. So the estimate is going to be based on the prior week, and my assumption is that if all of the traders in the world figured that this price here was too high, there's just no way they're going to trade 1 pip higher, that to me is resistance. And it's resistance because if that price was too low, if this price up here was too low, meaning traders were thinking, you know what, I really think the pound is worth a bit more than that, I guarantee you it would have traded higher. That to me is resistance. It's not because it's, there's a line on the chart. It's not because of some Fibonacci level. It's simply because that's where the market traded. Okay, so we've got to remember, look at the market from a common sense standpoint, and you will rarely go wrong. Now we can add some tools to that, okay, and we'll get to those. So the estimate is going to be based on the prior week. I'm going to look at the high, I'm going to look at the low as resistance on the top and support on the bottom. Okay, so again, if traders thought that this low price was too high, meaning that they were selling it more, if they thought it was too high by even 1 pip, they would have pushed it lower, bottom line. But they didn't, so that is support.